This week on Q&A, our guest is Meredith Whitney, a financial analyst and chief executive officer of Meredith Whitney Advisory Group, LLC.
Meredith Whitney, in Michael Lewis's book, The Big Short, he says, and then came Meredith Whitney with news. Whitney was an obscure analyst of financial firms for an obscure financial firm, Oppenheimer and Company, who on October the 31st, 2007, ceased to be obscure. On that day, she predicted that Citigroup has so mismanaged its affairs that it would need to slice its dividend or go bust. Were you surprised at how much Michael Lewis relied on you for starting his book?
I'm surprised that I would even be on the a page of Michael Lewis's book, because first of all, he's an incredible author and probably one of the most important authors journaling the financial times as we know them. So I'd always been a big fan, and when he called me in March of '08, I remember saying to him, "Michael Lewis, is this Michael Lewis, the Blind Side Michael Lewis?" And he said, "That's the first time I've ever gotten that. I usually get Michael Lewis as this Liar's Poker Michael Lewis." So, you know him. He's an extraordinary individual, talent, personality. And so I wanted to talk to him whenever he called, and I was really open with him because he, whatever you tell him, you can tell him a story. He'll tell you the story back, and you'll learn something from his story. So he's amazing. Of course, I'm surprised, but I also never thought of myself as an obscure analyst at an obscure firm. The fact is that prior to that time, people didn't really care about financials. So I don't know that I was obscure within the world of financials, but financials weren't on anyone's radar screen. Banks really weren't something that people thought too much about. And certainly from a risk perspective, banks were never associated with high risk that they could bring down the system.
Let Michael Lewis say it in his words as he did when we talked to him about his book.
She's a catalyst for me in this story. She was until very recently what's called a sell-side analyst, which means she works for the Wall Street firm, a Wall Street firm that is offering stocks to the public. And she worked for a firm called Oppenheimer, and she was a bank analyst, a financial sector analyst. And Meredith Whitney, who I'd never heard of, starts saying things in late 2007. Is when I first started paying attention about the Wall Street firms that just sounded different from anything I'd ever heard. That she was saying they basically didn't understand the risks they were taking. They didn't understand their own balance sheets. That they were going to. She predicts Citigroup is going to have to cut or eliminate its dividend a week before they actually do. She seems to know more about what's going on inside the places than the people who run them. And it's almost her tone it was as interesting as what she said. She was actually kind of condescending to these Wall Street people, and I call her up because it just seemed she was making a different sound. I thought, I haven't been writing about this world, but I'm kind of curious who this woman is and why she thinks this. And she made such sense that she persuaded me pretty early on that she didn't put it this way, but I put it this way, that the Wall Street firms have become the dumb money at the poker table. That somehow these firms, which used to be the smart money, when I left Salomon Brothers, the last thing you wanted to do if you were an investor was be on the other side of one of Salomon Brothers' trades. If there was some zero-sum bet to be made with Salomon Brothers, you did not make it because you were sure to lose money. And what had happened is somehow the firms had turned stupid, or rather as institutions, that they'd become the dumb money. And so that, I was curious, that made me curious how something big had changed. And then the natural question, of course, was, well, if they were the dumb money, who was the smart money?
He says that you led him to Stephen Iseman. And who is he, and why was that important to his story?
I think Michael's original tact was going to be different than what it turned out to be. So we started speaking in March of 2008, and he came about, his perspective was fresh, and I don't know, he just wanted to learn. And so it wasn't until September 2008 that Steve Iseman was even mentioned during conversation. He had asked me about investors who were involved in buying the brokers, investing in the brokers, and then had now become entirely demoralized and dispirited by the brokers that would never invest in brokers again. And I said, there is that group. This is investing in the brokerage companies, but there's also a group that invested and shorted a different type of game, and you should meet my mentor, Stephen Iseman. So Steve, I worked for from '94 to '98, and he is really well depicted in Michael's book. A character, love him or hate him. I happen to love him. He is smart. And the hits keep coming. So when I worked for Steve, we wrote on the fall of Glass-Steagall. We wrote on the subprime home equity industry. I mean, working for him, I learned how to do this and sort of his craft. Hit every single turn and looked at what was happening in the world of financials from a point of history, from a cultural angle. And that got you into layers of the financial system that you would have missed otherwise if you had just looked at bank stocks. And I think people who didn't connect the dots missed the entire collapse of the system. People who were always looking to connect the dots through the story were people who got it. And it was a few who got it, but it was, you had to have an unorthodox way of approaching the system. So it's not just that Steve is really smart, because I think Michael Lewis meets a lot of smart people. It's that he is, you couldn't, if I didn't know Steve, I would find it hard to believe what he wrote about on paper, because the guy is different.
You mentioned selling short. Again, define that.
That's when you bet a company's stock price is going down.
Why would they even allow that to happen?
Well, there's a market, so there's a buyer, there's a seller. It's they're good reasons that trade exists, and oftentimes, a lot of the short sellers tend to get into a story, see a company's weakness before anyone else does, and ends up shining light, the greatest disinfectant on what otherwise is a dubious company or story.
As you know, for a generalist, and I actually have the analysis that was done by a law firm on the Dodd-Frank financial regulation legislation here, and I've read it, and you keep fighting as you're reading it as a generalist. What does this mean, and all that? I'm going to ask you.
As working in finance, you still fight with it to see what it means.
Well, I wanted to go back to where you started in this whole business. How did you train yourself in the first place, and why did you get into it?
I was a history major in college. I went to Brown University, and in college I studied what was interesting. The Berlin Wall was crashing. I wanted to study German history. It was the linchpin to all of modern European history. And then when I graduated, I wanted to go. I grew up in D.C. So in D.C. at 15, I worked on the Hill. I worked for Jack Danforth, and I worked tirelessly until I went to college in politics. And when I graduated from college, I wanted to go to the most competitive environment in politics. Obviously, the most competitive environment is D.C. In New York, I wanted to go to New York. The most competitive industry in New York, as I saw it, was finance. I didn't even know research existed. And so once I discovered what research was, I really narrowed my search. Anything else on Wall Street I didn't want to do. I didn't want to sell anyone else's product. I didn't want to, I wanted to make my own product and sell my own product because that's what I trusted. And what research ended up being is a field of work where you get paid to learn, and fascinating, and the access to information is incredible. So it's truly a meritocracy, that the harder you work, the more you can do, the better work you can do, and the farther you can advance. So my first job in research was working for an oil and gas analyst who ended up firing me because, as I learned later, he thought I was too aggressive and I wanted his job. But I was 23 at the time, and he was in his 40s. But at any rate, so then getting fired by him was the best thing that could have happened to me, because then I ended up working for Steve Iseman. Now, oil and gas is interesting here, because when I had my first job in oil and gas, people used to say, oh, remember the energy crisis in the 70s. And I would think to myself, in the back of my mom's station wagon. I mean, not having any experience within the oil and gas industry was a real a real detriment. Getting into financials when I did in the early 90s was the perfect time, because that's when the securitization market was really getting underway. That's when subprime was really getting underway. That's when credit card lending was becoming a national business. And that's when, of course, Glass-Steagall fell. There was so much going on at that time that I was growing up with the industry really growing up, so I didn't miss anything. And from an accounting standpoint, as I said, I was a history major. You could learn on the job, like anything that was going on. You just dug into, and it was a level playing field for the people who really wanted to work, and I really wanted to work.
What had your mother and father been doing?
My mother was an executive recruiter, and my dad was in finance in different areas. But they didn't have a lot of say in terms of me going into research. I'm the youngest of 3 kids, so I'm pretty strong-headed.
Explain what a researcher does.
A research analyst typically is siloed into an industry, and be it financials, you're siloed into banks. And so you cover let's say the 10 biggest banks in the United States and cover the banking industry. So you'll rate a bank stock buy, sell, or hold, and you'll have relative ratings. So you'll have, let's say, 3 buys and 3 holds, and 3 sells and 4 holds. That's you're just talking to investors, and the investors would be the people that you give your money to, that run mutual funds and 401k plans, et cetera. And so I'm advising those fund managers on what to buy, what to hold, what to sell.
Michael Lewis referred to an obscure company called Oppenheimer. It seems like I've heard the name Oppenheimer for years. Is it still there?
Oppenheimer is, Oppenheimer's a great old name, whether you look at it in the financial sphere to, date its roots back to South Africa, date its roots. When I joined Oppenheimer originally, it was a research boutique, and it was one of the best research boutiques on the street. Small, but things were small back then. This is early 90s. And then it went through a couple of iterations when you had consolidation in the late 90s and became CIBC, and then CIBC sold Oppenheimer back to another retail operation. It still exists, but it's small, and it's not what it once was.
I've got a list here somewhere of all the things that happened to you after this prediction back in 2007. This is something called Buzzle.com. I don't
Never heard of it.
Yeah.
If it says good things, I'll like it.
Well, here's what it says. It maybe said that Whitney has made great strides in a short period of time. That is the reason that she made Forbes' list of the best analyst stock pickers, in addition to being included in the New York Post 50 most powerful women in New York City. She was also ranked in Fortune 500's 50 most powerful women in business. I want to stop there. There's more, but why do you have to be the 50 most powerful women? Why can't you just be one of the 50 most powerful people?
I don't know. Write to them and tell them.
I mean, where does that come from? Why do they still segregate men and women in these kind of lists?
I don't know. I would say from the Fortune Most Powerful Women, I was just excited to be invited to the conference, let alone to make the list. It's a great, great group of women, and we have a lot of fun, and it's a great networking opportunity. So women don't typically network for some reason. I don't know why that's the case. They're usually focused on the task at hand. So that's opened up a lot of doors in terms of meeting incredible people. Why it's segregated? It is amazing to me that there are so few women on Wall Street. It's just a fact. I look around when I go to conferences or when I go to events or when I have events, and it's, I call it a man zone. It's just, there are a bunch of guys. It's been a great advantage for me because I'm different, and I don't care about how I look because I'm the only one there. I don't have a lot of comparisons. So I think I'll ask questions that other people won't ask. If people underestimate me, that always works to my advantage. Which happens a lot. So I don't mind asking dumb questions. But it's sad to say that there are so few women in finance.
Are they scared to mess with you because who you're married to?
I think.
Explain why I said that.
Okay, so my husband is a retired World Wrestling Entertainment champion. He's 6'7", 250. He'll be like, no, I'm 245, but he's 6'5". He's a big guy. I really don't get messed with that often. But maybe it's because I
was really kidding.
It was a tough time after the City call, but.
And talk about that. But by the way, the other things that they say on here, the Times 100 world's most influential people came along. What did this all just happen overnight? And not your learning, but all these awards that you were given, names, your lists that you were put on.
It happened within a period of about 12, 18 months, and a lot of these lists happened, it seems like, after a lot had already gone on. So the Time 100 list, which was another sort of pinch yourself list, great party, happened in May 2008. 2009 rather. So much had gone on by then. I had forgotten, and I'm not very self-aware, so I don't think about the lists that I'm on. I'm just, again, sort of like, that sounds like a great group of people to be around. How cool. Hope they don't figure out that I don't belong here. It happened pretty quickly. Again, I remember in the late 90s talking financials, talking to investors. You couldn't sell financial stock to save your life. People wanted growth. People wanted tech, media, telecom, the internet. People had zero interest in financials. And it's, the high point was over 20% of the S&P. So it was just not a sexy sector. And it got, I think that's why it caught so many people off guard. And so when it hit, all of a sudden people were like, oh, who's this obscure analyst? I'd been in the business for over 15 years. People all of a sudden cared a lot. And so what I loved about the opportunity was it doesn't feel like work. I work all the time. I'm always on to the next issue. I don't stay on one issue for too long. A good analyst would market their thesis over and over and over again. My thesis, once I'm finished with the report, I'm on to the next one. And time moved so fast during that period that I just had it. I had the research. I had, from the Citi call, then we moved to a big call, Ring of Fire, which was the regulatory capital was determined by the ratings of Moody's and S&P on certain securities. So this was November 15th, November of 07. That was a much bigger call than the Citi call, but I had that 2 weeks later, and that's a huge call. And then 2 weeks later, another call, and then in the just a month later, a call on the monoline insurers. I mean, it was staggering the amount of work that we were putting out, and it happened right at the time when people cared. So it was a perfect storm.
Think back to the Enron situation. If I remember right, there was a short seller on a telephone call with Jeffrey Skilling that started that whole process down. And here you are with a report that says, and I want you to explain what you said about Citi in 2007. Who is Citi anyway, and what happened to it after you made your call?
Okay. Interesting about the Enron, if I could go back for 1 second. So my brief time as an oil and gas junior analyst, I actually knew what Enron was. I didn't know how, I didn't know how complex the organization had gotten, but I certainly knew how revered the company was. And so at the time, in 2001, everyone was worried about Argentina defaulting. And so I remember writing a note on a Sunday, December 1st, and saying this will be bigger than anything you can imagine when Enron goes bankrupt. And at the time, you could see who the creditors were, and so that was a big call. With the Citi call was very straightforward. So Citi was one of the largest banks in the world, with over $2 trillion in assets, and it had made so many acquisitions over the years that you couldn't really see what was coming or going with the company. So each quarter they restated. And when a company restates, it's very hard to get a historical perspective on what's really happening because they'll restate every line item, so you don't know what you're really looking at.
Let me know, just to make sure, so put some names on it. Was Sandy Weil in charge at that time?
No. Chuck Prince was in charge. Sandy Weil had gone, but Sandy Weil was in charge when they made the major deals between Travelers, Solomon, Citibank. I mean, he was the architect behind a lot of that.
And was Bob Rubin there then?
Yes, he was.
And Bob Rubin, former Secretary of the Treasury, was involved in advising Barack Obama when he went into office and all that.
Yes. And so what I looked at, and I remember the summer of 2007, they had appointed a new CFO earlier in 2007, they appointed a new CFO, Gary Crittenden, who had come over from American Express, who I had had a huge amount of respect for. They had a meet and greet with Gary Crittenden, and
he was chief financial
officer, and that was the summer of 2007. So it was before all of this. And I remember listening to one analyst who was, now look, I work in a complete nerd factory, dork factory. If you went to some of the events with me, you'd be like, why is everyone in black socks and sandals? It is about as nerdy as it gets. So one of the nerdier analysts, and I mean that as like high esteem, the nerdier you are, the cooler you are in my field, said, I've just given up on modeling, which is predicting what cities a company's going to earn, modeling Citi because it's just gotten too complex. And thinking at the time, but you can't give up. That's your job. That's what you get paid for. So that in the back of my mind the whole time, I tried to make Citi and my model for Citi as simple as possible. And the rationale of downgrading Citi to a sell, which is a huge deal for an analyst because you want everyone to like you, you want to get invited to meetings. Putting a sell on a company turns out to be dangerous and is highly unpopular.
Why dangerous?
Because people own the stock and you're telling people to sell it and people are typically losing money. You anger a lot of people. So everyone likes you when you put a buy on the stock and they make more money. People don't like it when you put a sell on a stock and you lose money.
You're talking about people.
Investors.
If I own Citi just as an individual investor, would I read you, or would this be an institutional group that would
It'd be an institutional group. But at the day I put this report out, pretty much everyone was reading it. But to go back to that time, though, they had just reported, just a few weeks after they had reported third quarter numbers, and I looked just simply at leverage, how much debt they had relative to the equity they had. And I looked at the leverage compared to the other banks. And so the analysis was basic. If they needed to get to a tangible equity leverage ratio comparable to their peers, they would need to raise $30 billion, sell over $100 billion in assets, as an addition, they weren't going to make enough money to pay their dividend, to be able to pay their dividend. So it was a three-pronged report. The report was 7 pages. Any generalist could have read the report and known exactly what I meant and exactly how simple the problems of Citi were. And that's how I present things. If I don't understand something, I will work and work and work until it's laid out in a way that an art teacher or a veterinarian can understand it, because it's not that complicated. You just have to have it explained to you in a way that is not in some crazy vernacular.
But with the billions of dollars that's spent in this town for analysts and all this stuff, why were you the only one that figured this out?
I don't know. During the next, I would say until now. So from that point, when I felt like I was just starting to get a ton of attention for my work, I became very concerned that, I became concerned that not only were more people interested, but people would start working harder, and that anyone could do what I was doing. So why weren't they? So I remember starting to go on Bloomberg television because when I wrote a report, I wanted to make sure that people knew that I had written it first, as opposed to just being plagiarized for ideas. I mean, information is everywhere. I wasn't using information that anyone could not get, that was proprietary to me. It was as simple as it could be. And particularly then with the issue with the regulatory capital and the rating agencies, that was just a course of several conversations, conference calls with the FDIC. That anyone could have done that. And I remember looking behind my back thinking why aren't other people doing this? And it happened, and it's still happening, which is great for me. But I still think it also makes you think am I crazy to do this? Am I right? Could I be that alone and be right on this? I don't know if that makes any sense, but being in the consensus is a lot more comfortable.
I want to show you a headline on a Wall Street Journal, which was a couple weeks ago. And when I saw this, I thought of you, because one of the things I want to ask you about is regulation and everything else. But when the new credit card law came into effect, the Wall Street Journal here has credit card rates climb. Everybody watched these hearings on Capitol Hill and watched the bill being put together, and the last thing you expected to see was a headline like that: credit card rates climb.
Yeah.
How do you write legislation and the first day it goes into effect, everything goes up?
Well, unfortunately, so this happened before the Dodd-Frank bill. This was part of the CARD Act, and what the CARD Act did was it was designed to protect consumers. So all that fine print that you can't really read and you don't really want to read would explain to you that if you're over your limit, you get charged a fee, and if you are late on your payment, you get charged a fee, and so they called those hidden fees. Or if you, there were some really bad things that were going on, which was double cycle billing and excessive fees charged. But the bad side of this was that they put into effect measures that prevented banks from repricing. So a credit card loan, specifically, this is very interesting and very important. A credit card loan is an unsecured loan. So I've got no collateral behind it. So if you go bust on your credit card line, I've got nothing to collect. That's it. I'm done.
You mean you're the banker or
the
you're
banker.
the credit card issuer?
So what's so important is that I look at your monthly credit scores and your behavior on a monthly basis to assess the risk. So if you're late on your phone bill, and I'm smiling because I'm about to get to my funny line here. If you're late on your phone bill or you're later on your electric bill, I make a mental note of that. But if you're late on your cable bill, so did you know that when people are late on their cable bill, that's the biggest red flag to lenders, because men will pay their cable bill beyond any other bill. God forbid you don't have cable TV, right? And so if you're late on your cable bill, you know that the person is, the bank, the lender knows that the person's in trouble or has a higher probability of going default. So what I'll do is I'll reprice, or I'll put into mechanisms. I can cut the line. I can still cut the line, but I'm going to reprice on the fly. I need to have that so I can effectively price for risk. They eliminated that. So if I now want to reprice your loan, and I've seen you spend a lot of time in Atlantic City gambling, and I've seen you be delinquent on a bunch of bills, I have to give you 45 days notice now to reprice. So what the lender does now is say, I'm not going to make that loan. So I'm going to cut lines to individuals. Over 1.5 trillion of lines have been cut from the system.
You predicted like 2.7 trillion would be cut by a certain point. What, the end of the year? Or?
Over the next 3 years. So we're over 1.5 trillion. Oh, and when I made this prediction, it was May 2008. I got so much grief on it. People thought we were so angry. But the idea was, if you can't price for risk, you're not going to extend the risk. And that's what's happened. So then for the existing card holders that still have, they have to figure out a way to make money. So they charge you excessive fees, they'll raise your rates, because they don't have the optionality of repricing on the fly. So it becomes expensive. And what's worse about this is, for the guys who get kicked out of the system, the less wealthy or poor people, it gets a lot more expensive to be poor. And now what's coming, a consequence of this is the growth in prepaid cards and payday lenders, and that's a very expensive way of paying for things.
What is your basic feeling about the bill that was passed, the financial services bill that was passed in Congress a couple months ago?
My basic feeling is that it's going to take a long time to figure out what the results are going to look like. So any of what was feared to be the toughest part of the bill was given a much longer runway timetable. So in some respects, many, many years to implement. So I think it's very complicated. I think that they tried to put a massive bill. They tried to put a lot of a basic outline together and let committees work it out. So we'll see. It changed on the fly. The Durbin bill that was passed, what seemed like last minute, which pressures a lot of the payment companies, came out of nowhere. So it was heavily political, and I take it I take it fingers crossed that it's an outline and some good things can come from it.
I have this document here that was prepared by David Huntington, who is a partner in the Capital Markets and Securities Group at Paul Weiss, Rifkin, Wharton, and Garrison. Do you know him?
Nope.
It was published on the Harvard Law School Forum.
Okay.
I figured that was somewhat credible, all of that. And it basically is a synopsis. And I don't want to bore the audience, but I want to read what some of this stuff is and see if you've interpreted it. For instance, I'll just pick out one. The Act introduces significant direct regulation of over-the-counter derivatives transactions. Among the most notable provisions affecting the OTC derivatives markets are clearing and trading. The Act authorizes the consumer, the CFTC, which is the Commodity Futures Trading Commission, and the SEC, the Securities and Exchange Commission, to mandate central clearing of OTC derivatives that are determined to be appropriate for clearing and capable of being cleared. Again, I don't have any idea what they're talking about here, other than I know what derivatives are based on all the chatter. Does that sound like something that's going to work?
I think that it will work. I mean, the more that can be put on a transparent clearing system, the better. And I'll give you an example. You know, when you wanted to get a stock price, a legitimate stock price, just from looking at a ticker, a bid, or an offer, 25 years ago, you would have to call a stockbroker. Today, you can pull it up on your computer screen. You can't do that for a bond. And so I think the bond market, the credit markets need to move towards this. So they're starting with OTC derivatives. I think more and more will move towards open exchange, and that's so much better for the consumers, in my opinion, because there should be transparency. There should be the difference between what someone's offering for security and what someone's willing to sell should not be so wide. And you think with transparency, it would be you would narrow some spreads. That's less profitability for Wall Street, but I think better for the system.
When you say bonds, to someone who's never bought a bond, what's the difference between a bond and a stock?
A bond is when we talk about collateral, a bond is going to be, typically will be a collateral holding. So you get actually the first. If a company goes bust, the equity shareholders are wiped out. The bonds actually own the collateral of the company, and so that is going to be typically an annuity style payment. So you'll know you're getting a 5% coupon for a stated period, and it's basically a company borrowing and you financing the borrowing of the company. A stock is getting a piece of the equity of the company, which is the growth prospects. So you're sharing in the upside. So it's a higher risk vehicle. The bond is a lower risk vehicle. The bond market is far bigger and far more widely held than equities, but equities are more transparent than bonds. It's kind of crazy.
How did you learn that? When did you learn it?
I think most people know the difference between a stock and a bond.
No, I'm talking about go back to the beginning where you were in Brown, you were a history major, you came out, you went to work as an analyst. When did you start learning the language? And how would you recommend somebody that just is totally confused by all this to learn it?
Well, first of all, start with something that really interests you, and then let's say you're dying to go to Spain, right? Because you love Spanish history. You'll get to the point where you'll learn the language, but figure out what you want out of the equation first, and then get to the particulars. There's nothing about finance that's like rocket science, and this is probably the most frustrating thing for me about how you think about Ponzi schemes. The biggest Ponzi scheme for Wall Street is telling someone who's worked really hard to earn a buck that they're not smart enough to understand how that buck is going to be invested, which is utter nonsense. Figure out what interests you. If you are an avid sportsman, find out what area of that you can invest in, and then you'll learn the language and you'll learn a capital structure. It's very interesting. I think that there's stories within all of this, and if you do your homework, you can be just as smart as anyone. I mean, for crying out loud! I mean, look, I was a history major.
But go back to the Big Short, the Michael Lewis book, which is still on the New York Times bestseller list, has been all summer. He says that you led him to Steve Iseman. What did Steve Iseman teach you, and where was it that he taught you, and what was he doing at the time?
I would describe the way, so Steve Iseman is a lawyer by training, and the only distinction I would make out of him being a lawyer by training is he reads really well. And I remember being so impressed that he would take a book review, the New York not the New York Times Book Review, the New York Book Review, which is some, I don't know, 300 pages, and read it during lunch and remember everything. So he is a prolific reader. So to teach me, and I just learned this just from observation, read everything. You never know where you're going to get ideas from. I remember working for Steve thinking, man, this guy is so smart. Am I ever going to learn? Am I ever going to be able to think for myself? And I ended up learning to be able to think for myself, but he just, there was no rock unturned. He followed things that he thought were genuinely interesting. I'll give you an example that is not mentioned in The Big Short. In 1996, 1995-96, they were starting to do work on changing Glass-Steagall, and this would mean that banks, which were only allowed to have 10% or below of their revenues come from the capital markets business, would be able to increase that up to 25%. And so what, for Steve, that registered is, oh my gosh, all these banks are going to buy the regional brokers and get that quick fix immediately. So we initiated coverage of the regional investment banks and called for the consolidation. We launched that. Oh, and just some fun for your DC audience. So I was his junior analyst at working the phones, and I will work until the cows come home. I would call I called DC until someone answered the phone. The head of the chief legal counsel for the Congressional Banking Committee ended up not just picking up the phone, but then taking my calls. I found out later because I was the only girl who was calling him. Anyway,
so it worked for you. It
worked for me. So, but there's information all over the place. We were just doing the work and we were focused. So we came out with this report, and people poo-pooed it, saying, "Oh, it's not going to happen. There's no way." And the rest is history, because there was massive consolidation amongst all of the regional banks, and that's just one of the things that of going for taking an idea and believing it and having all of the conviction because you've done all the work, and being so out of favor and out of consensus, and then being right. The thrill of being right is the single biggest aphrodisiac of this business. It's nothing else. It's being right and standing on your principles. Something else. So a bad story was that on the flip side. So this is when we were recommending stocks. On the flip side, we came out with coverage of. We came out with a short report on subprime auto finance. So during the mid-90s, over 30 companies, subprime finance companies, went public, and today virtually none are left. They all went bust. At a really interesting time, there's a murder alleged, and at any rate, so we came out telling investors to sell short the shares of these subprime companies. And the time of our report coincided with when one of these companies was trying to raise money. And this was a Bear Stearns deal, Olympic Financial. And since the company's trying to raise money, we end up disrupting the deal and causing the company to have to pay 300 basis points, I think double what they would have had to pay prior to our report. So Steve got a letter on letterhead stationery, personalized letterhead stationery from a broker at Bear Stearns that said, "Steve, you're a blanking idiot. YOUR," on his letter. And I remember thinking, okay, this guy's a real idiot. But that's the equivalent of what I was getting, which was really vicious emails from people's personal email accounts. Anyway, but at any rate, thinking, man, we've got to get this guy security. He's going to get death threats. It's going to be. So I kind of lived through it with that report too, and the highs and lows, and just I think feeling like it was okay to be in the minority if you were right and you were going to ultimately be proved right. That wasn't scary to me. And then the standard, which his standards were my aspirations, so that was so comfortable to me. And then, if you have to say integrity, you don't have it, but he's an ethical guy. He's got boatloads of integrity, and so I was so comfortable with that. So it just felt like Steve is a very important person in my life because he taught me, and he validated what I was interested in and believed in me. And so for that, I'm forever grateful.
When did you start your own company?
In February 2009.
How did you start it?
I funded it myself and opened up the doors for business.
But give me an example of what you had to do. How many people worked there? How big are your offices? Where are they located? And
Okay.
who are your clients?
Okay. So the timing is, and I got paid on January 30th. So I got my bonus on January 30th. I started February 18th. So it was, and I went on vacation for a week, and then I had a couple things to do in the office. So how I started it, you have to get lawyered up and form an LLC. I soft circled some clients to say, if I hypothetically were going to do this, would you follow me? And I had tried, and I think made clients a lot of money, so people were willing to believe in me. So much so that we were cash flow positive in the second week we were open.
Not to interrupt, who are the kind of clients that you have?
I have clients from anywhere from mutual funds to hedge funds, long-only shops, meaning people who just buy, go long securities, macro funds. We have some corporate, at the time we had some corporate clients, and it was, so we started out in temporary offices, and it was in an internal hallway. I could hear someone opening a candy bar in the office behind me. It was really close quarters. And it looked like a fallout shelter. There were computer boxes everywhere. It was absolutely unglamorous. The first person to visit my office was John Thane. The second person was Michael Lewis. So that the people I had working for me were so wide-eyed, being like, is Elvis Presley going to walk in next? It's incredible. Then it took us till June 1st we moved into our current offices, which are about 4,500 square feet on 57th Street between 5th and 6th. We converted the old New York Jets headquarters. Beautiful, beautiful offices, edgy, young, new. It's really, really cool. And so going back to in terms of how many people we have, I started the firm with 4 people. We have 14 now. I would have thought we would have a ton more. I think in the next 3 months we'll be hiring probably 10 because we're building out our broker-dealer. But we're really careful about who we hire, and so everything that I didn't like about traditional Wall Street, which was I hated the culture. People were not nice, and it's so easy to make people feel good about themselves. Steve Iseman told me when I did a great job, and he didn't have to tell me when I did a bad job because I wore it. I really understood I did a bad job. But giving people feedback and being nice to each other and having respect and throwing an ice cream cake party when it's someone's birthday, it sounds really corny, but it makes all the difference in the world. So we have I'm just so thrilled. And I have more resources now, so in terms of the coverage that we do, it's so much broader and better.
The American people don't think much of Wall Street. I think all the polls show that. Do they have a reason not to think much of them? And is any of this, and I haven't read much of the other provisions of this, but is any of this going to work?
It's a step in the right direction. I think that the attitudes have to change on Wall Street to really reintroduce a level of respect for your customer, for the consumers, and to make it your business to empower consumers and customers as opposed to intimidate and keep these guys in the dark. Because look, it's like playing tennis. When you play tennis with someone better than you, your game rises. When you have more intelligent and educated and informed clients and customers, you perform better. There's been a very dangerous, unfair, and clearly perilous relationship between Wall Street and Main Street that came to a thundering crash, and that has to change. You've got to level the playing field, equalize information bases, and it'll work out better for everyone in the long run.
Some time ago, you had a list of the 7 most important people in the economy. I've got it here in my stack somewhere. I remember one obvious one of them on the list was Tim Geithner and Barney Frank and all that. Is that list the same today as it was? Do you remember the list?
So that was a long time ago. It was probably.
I've got it here
Look, it was
somewhere.
probably 9 months ago, and it seems like, or 10 months ago, and it seems like an eternity.
Well, let's just create a new list then. Who are the most important people today in finance in the country?
There's no doubt about it. I think that Barney Frank remains an extremely powerful force within finance. I would say one person that is not on the list, that was not on the list then, that has clearly put himself on the list is Al Franken. Who would have thought? The comedian from SNL and now the senator from Minnesota, with the Franken Amendment on the rating agencies. I think that's the importance of sorting the rating agencies out is cannot be overstated. So I'm probably going to mention.
Why should we pay any attention to the rating agencies after what we found out about them?
Well, you shouldn't probably pay any attention to those rating agencies, but you need rating agencies in the system because people need to have a guidepost on where the risk lies. So they're individual investors that just need some standardization of, okay, I know I'm going to get paid this, but I know I'm going to assume that risk for it. That's fine. Rating agencies are fine in principle. They just have to be run right and done well. It's like, why would anyone pay for any type of ratings? I rate equities. Why would people? Because you're right. Because you protect people and you make people money. Every business should be that same way. The rating agencies, in terms of the credit rating agencies, have been a duopoly for 20, 30, 40, 50 years.
I found the list. It's Ben Bernanke, Tim Geithner, Sheila Bair, Elizabeth Warren, Larry Summers, Barney Frank, and Chris Dodd.
That actually turned out to be okay.
Still the same? Would you, and where do you, in this, by the time this runs, they may have made a decision on who's going to head up the consumer agency, but where are you on Elizabeth Warren and somebody else?
I think Elizabeth Warren looks like she's, well, at least she's, as of late August, she's pulling together all of her lobbying power to get this job. She's well respected, and I think she could offer confidence back to that role. And she seems seemingly very well liked as well, and a good communicator. I might take Larry Summers off that list and replace him with Al Franken because it's really been the Treasury's game. So the White House was a big proponent of HAMP. It's the Home Affordability Modification Program, which was a resounding disappointment. But they really left it to the Treasury to execute. So the Treasury has really been, I think, very, very active, much more so than the White House. The FDIC, I think Sheila Bair has done a terrific job. Look, there are hundreds more banks to fail, but she's doing it in an orderly process, and that is no small feat.
You mentioned that you'd worked for Jack Danforth, a Republican from Missouri. By the way, was Clarence Thomas there when you were there?
He was not there, I don't think. I was 15. I can't remember. Who was there? I worked for Susan Schwab, who was the former U.S. Trade Ambassador. I worked for her. I think I worked she, well above it. I was really good at the auto pen. I don't know if you remember that.
I do. I bring it up because are you very political today, and are you on a side, and do you see the Republicans and the Democrats doing a better job with this whole business of financial regulation?
I'm a registered independent, and I have been ever since I could vote, so I've voted all over the aisle. I vote for candidates. I'm really not that interested in parties. Pick your person. I think that the states have a really impossible job with their fiscal crises, and so may the best man win, party or otherwise. It is unfortunate now, as we head into the midterm elections, that you have a stalemate of policy making where we need stuff, we need stimulus, we need to extend Bush's tax cuts in every income category. This economy is in cruising towards a double dip in a bad way, and we have to do something about it. Housing certainly will take a double dip in the fourth quarter. So, and that you just have to let that happen, I think. But you have to create structural reform, and that is nonpartisan. The partisan politics right now is maddening, and I think is costing our country a tremendous amount. And I think that's why approval ratings across the board are so low. If you underestimate your audience will turn on you. And I think politicians have grossly underestimated the American people, and that's dangerous.
Here's something from the bill. Financial Stability Oversight Council. The act seeks to mitigate the systemic risk of financial collapse through several legislative and regulatory initiatives, the most substantial of which is the creation of a 10-voting member Financial Stability Oversight Council, the council they call it, which will be chaired by the Secretary of the Treasury and will include the chairman of the Board of Governors of the Federal Reserve System, the comptroller of the currency, the director of the newly created Consumer Financial Protection Bureau, the chairman of the FEC, the chairman of the FDIC, the chairman of the CFTC. I'm not going to go on. There are a lot of other agencies. Why won't any of those agencies be able to fulfill this goal? Why is there another agency required in this process?
Isn't that, you should know this better than anyone, isn't politics all about creating a committee to create other committees? It sounds like this. One thing that is clear, no agency lacked the powers to prevent this crisis. They just weren't doing their jobs. And you're lulled into a 15-plus year period of economic nirvana. And so people are asleep at the wheel. For the same thing, you can look at banks, why banks had such a difficult time at the beginning of this crisis, because the collectors in the banks had never seen a bad loan. They didn't really know how to collect. They had to completely, recalibrate themselves once they realized that the loans they made were not going to repay as easily as they had. And you see that for the agencies as well. So it sounds like, this is coming from someone who doesn't want to work in politics, a committee to create another committee. I don't know that's necessary. It's more red tape. It's certainly more expensive for people, and it's going to require, at the minimum, it's going to require banks to have to hold a lot more capital. But as
is that good or bad?
That's good. But as I'm just going to steal a line from a friend of mine, this was designed to make sure that too big to fail wasn't an issue. Now it's enshrined, too big to fail.
Here's another one: treatment of certain former bank holding companies. Any company that was a bank holding company having total consolidated assets of $50 billion or more as of January the 1st, 2010, and received financial assistance under or participated in the capital purchase program established under the Troubled Asset Relief Program will be treated as a non-bank financial company supervised by the Federal Reserve if such company ceases to be a bank holding company at any time after January the 1st, 2010. What in the world did I just say?
I think what people call that the Hotel California
they do.
provision.
It's very good. It's in parentheses.
I'd call it the fatal attraction provision. Right? Once you go there, there's no getting out. There's no easy way of getting out. And what it was designed to do is people that sought shelter under the bank holding company during tough economic times can't all of a sudden then be free of responsibility during better economic times.
Special assessment. The Act mandates the newly created Financial Stability Oversight Council to impose special assessments on the nation's largest financial firms.
And the tax to prevent
to raise up to $19 billion to offset the cost of the act. The assessments will be imposed on financial institutions with more than $50 billion in assets. The $50 billion figure is magic in this whole process. What's so special about $50 billion? Who got there? How did they get there with that figure?
The $50 billion is the top 4 commercial banks and it's the major recipients of TARP. What they wanted to do was, it's very hard to be a small community bank at this point, and I'll explain it simply. Over the last 20 years, with the onset of securitization, so much of the lending in this country became, was consolidated up to a national level. So it was controlled by the top 6 banks. So the top 6 banks control over 2/3 of the credit card market, control over 2/3 of the mortgage market. The little banks really became adversely selected business models. Now, the little banks are critical to small communities. So if you endanger the little banks, you have communities go under. They're the primary lender to commercial real estate, to small businesses, et cetera, in those communities. So the small bank lobbied like crazy to protect the community banks. And so they can't afford a special assessment as it is to get. Now, FDIC certain FDIC insurance. I think this was just changed. This law was just changed. They had to opt in and pay another assessment fee. So the fees for small banks are becoming prohibitive to stay in business. So they wanted to eliminate those, and they wanted to tax the guys who could afford it. It sounds like the consumer tax policy. But also, if they're never going to let the guys who took TARP forget that they took TARP.
All right, we're about done. We have a little bit of time. This is probably grossly unfair, but I have to ask you about this. How did someone who deals in integrity and truth end up marrying a guy that dealt in showbiz, in World Wrestling Entertainment? And when I read on Wikipedia his background, I just had to ask you about this. It says in late 1998, Bradshaw, I guess was what he called himself. John
Layfield. But he was JBL towards the end of his career.
Teamed alongside Nation of Domination member Farouk to form the tag team of Hell's Henchmen, managed by the Jackal. After the Jackal left the WWF, World Wrestling Federation, Farouk and Bradshaw joined the Undertaker's new Ministry of Darkness under the name The Acolytes. I could go on. I won't.
It's more interesting than the Dodd-Frank bill, huh?
Well, it is interesting, but what is it? I mean, he dealt in showbiz, and a lot of people believe that stuff isn't rigged.
Well, as he would say, the storylines are scripted. The physical activity is not rigged. He retired in April 2009. He had a broken back. I mean, he is banged up. So
why did they go through that?
I don't know. I mean, he'd been a wrestling fan when he was a kid. He was a pro football player. He played for the Raiders. Then he played for the World Football League, the San Antonio Riders. And so he's been in contact sports for a really long time. He's a tough guy. He's a tough guy, but despite the packaging, he's one of the nerdiest guys that I know. He's got a photographic memory. His dad was a former bank CEO in Texas. So he's almost more interested in stocks than I am. So there's, I would never have expected to marry someone with that packaging, but I expected to marry someone like that he's 5,000 times a better person than I am. And if we read something, I'll give him, if something really important, I'll give it to him because he'll remember all the details of the particulars, and I zoom through things. We met when he was promoting a book. This is a funny story. When he was promoting a book, and we were on a Fox television program, and it came the point when you had to recommend a stock. So this is August of 2003. So the stock he recommended was Citigroup. And I turned to him, and I hadn't watched wrestling before. I'd passed it on a flipping channels, but I just remembered like the fat guys on Saturday and the trunks wrestling. Wasn't into modern wrestling, but I didn't know him, and I just said, why would you recommend a financial in a rising rate environment? Taking all of the wind out of his sails, and here's a guy who doesn't work in finance, and I just gave him such a low blow that I don't know why I did it. I wasn't thinking. There was no surprise why I was single, clearly, at the time. But then we went to dinner next door at Del Frisco's, and the group that we were on the television program with wanted to set us up, so they sat us right next to each other. I'm sure I was terrible and offensive in every way, and then a year later we got married. So,
on that note, we're out of time. Meredith Whitney of the Whitney Advisory Group, thank you very much.
Thank you so much.
Next, a debate among candidates campaigning